Dan, I want to begin with the economic data and how all of us watching this program should be interpreting really ugly data points like the one we got this morning.
Good morning, Jonathan. So the first thing I would say is Morgan Stanley's economist, Ellen Zentner, had predicted 3.4 million jobless claims. So this number came in slightly below our expectation. I think it is notable that the futures actually did bounce somewhat off of the lows this morning coming into this. So, look, this is going to be the first in many negative and somewhat historic data points in the coming weeks and months that speak to the dramatic nature of this sudden stop in the economy. You know, that being said, we've started to talk about this in the last couple of weeks at Morgan Stanley. The market, frankly, knows a lot of this already, right? We saw a 34% drop in the S&P from the February 19th high to the March 23rd low just this past Monday. And we've obviously bounced significantly off the Monday lows, but we think we are now in the process of a bottoming process within the markets, because we do believe while this will be the sharpest recession probably in history, it may also be the shortest recession in history. So we think there is room to be optimistic for the second half rebound.
Well, Dan, let me push back just a little bit, because unless you have any clarity on when this virus peaks and when these mitigation efforts end, how can you become constructive about what happens in the second half of this year?
Yeah, so listen, the epicenter of this particular crisis is the health crisis. It is incredibly tragic. It is admittedly ambiguous in many ways, but let's not forget we now have months of data to assess in terms of what the health crisis has manifested in various countries, and we've seen various countries' responses and the related results. So in our base case, looking at Morgan Stanley's healthcare expertise and other viewpoints, we actually think the virus has a chance of peaking in the U.S. in the next, call it 4 to 5 weeks. Now, that's obviously still uncertain. It's a gray area right now. But if you follow the trends in terms of China, Korea, and now, thankfully, Italy, starting to see the rate of change in hospitalizations and mortality slow day over day in Italy as of the last week, we think there is a chance that following along these trends, the U.S. virus cases could be peaking out, Jonathan, in 4 to 5 weeks. And look, we've already seen, on top of that, the velocity and the magnitude of the policy response come through. I think this can't be understated. Yeah. And we actually heard, former Chairman Ben Bernanke speak yesterday about the event being more of a snowstorm or a natural disaster than a depression. And I think the fact that we've seen that policy response is going to stave off that depressionary scenario.
One thing I've got to do, Dan, is sort of emphasize how uncertain the outlook still is on the public health side of things, and to make sure we leave those kind of things to the public health professionals to come out with those kind of predictions, because even for them, they have very limited visibility at the moment. For markets, what's interesting for me right now, and something I think you can help me with, Dan, is identifying the parts of the market which may be stabilizing. And I'm thinking about where we've seen real technical dislocations and tension in the FX market with this big surge of dollar strength. Have we seen a peak in volatility, cross-asset, not just in equities? Can you identify some signs of stabilization, some signs of easing of real technical dislocations that we've seen in weeks gone by, Dan? Can you see them developing?
Yes. So, excellent point, Jonathan, and a couple things to note. So the fact that we've seen already, the Federal Reserve step in and do what it took them essentially 8 months to do in 2008, they've done in like 8 days this time around. And that was really, really key, Jonathan, in terms of stabilizing some of the disconnects we saw in funding markets and the fixed income markets a week or two ago. And so incrementally, yes, we've seen some better liquidity and improvement in some of the key stress areas of fixed income, number one. Number two, in terms of volatility itself, Lisa Shallett, part of our team and the Chief Investment Officer of Morgan Stanley Wealth Management, has stated, and we agree, that volatility needs to peak before the market can make its low. That has certainly been the case in previous stress periods. If you look back at 2011, also 2008, you tend to see a peak in the vol a month or two before the market itself makes its low. And so we think, Jonathan, we actually saw peak volatility last week with the VIX closing several days in a row above 80, higher than the 2008 crisis. We've now subsided into the low 60s. And so we think peaking volatility, potential some easing for some of the alleviating stresses in the fixed income market are some of these early indicators.
Yeah. Well, certainly at 50, 60, it's still going to be choppy out there in the equity market. On my screen right now, the S&P 500 turning positive on the session, around about 20 minutes away from the opening bell. Dan, help us all out with this. For those of us thinking about deploying just a little bit more capital into risk assets, thinking about how we come out the other side of this, the early stage cyclical parts of the market where you want to play a recovery theme. I'm not talking about jumping 2 feet all at the same time, knee deep, just inching back in, just deploying a little bit of capital down. How are you thinking about those things and what are you telling clients?
Yeah, absolutely. So, number one, what we've been doing the last couple of weeks, both from an asset allocation perspective from the Global Investment Committee, as well as a bottom-up perspective in some of the portfolios, we've first been adding structural growth ideas, Jonathan. These are names that, as we all know, led the cycle the last 10 years. They've been acting very defensively the last 10 days. These are names that were expensive a month ago and today are fair to relatively cheap. So that's the first part of what we've been doing because, frankly, when you think about technology, software, some of these areas of the market that have secular trends, their 2-year earnings power is not going to be as affected by the sudden stop and sudden restart of the economy. But more to your point, in terms of the quality cyclicals and the value names, we're actually starting to look more at those from the bottom-up perspective. We haven't gone as heavily into them just yet. We think the next month or so is going to be an interesting time to reassess. And frankly, I think those are the names that are going to bottom when we do see the final peak in U.S. virus cases and the market starts to discount and starts to think, what will the economic recovery look like at that point? So names within financials, materials, industrials, they could certainly be bottoming or in the process of bottoming a month from now.